Tony, what's your take?
Yeah, so when you look at energy, I certainly believe that last week's highs are the highs we're going to see for quite some time. But admittedly, I didn't expect the markets the XLE to correct as fast as it did this particular week. And I think it's always hard to press new shorts when an ETF is down 17% in a single week, especially when the implied volatilities are as high as they are right now. Which is why Mike's trade is extremely creative, allowing him to do all three things, which is have no risk if XLE moves higher, participate to the downside, and get long effectively at that January breakout level. And he's using this ratio spread. And for viewers here who may not be as familiar with the ratio spread, one of the ways that you can think about breaking this trade apart is you're buying a 72.65 put spread, and you're paying for that put spread by selling another $65 put. And by selling that $65 put, you have the obligation to buy the stock at that price if the ETF gets below 65. But you are participating to the downside down to that 65 level from that $72.65 put. That offsets the risk for that short put down to the 58 level. And that's the level that XLE broke out in January. So you're effectively getting long if the ETF gets back to that level. And the fact that you're doing it for no cost means that if you are wrong and XLE bounces next week and continues to move higher back to recent highs, you have no losses here to the upside. The one thing that is important to understand is that if you do get a move to the downside relatively quickly, you're going to see at first a paper loss. You have to hold this to the August expiration or towards the August expiration before you start to see some gains, because you need to see those $65 puts decay before these start to really come in from a profit perspective. So those are some of the things to be aware of when you're trading a ratio spread.